Ladies and gentlemen, thank you again for being here with us today. We will now talk about one of the toughest challenges the companies and the funds will have to tackle in the next month, the next years. We will talk about reshaping debt structures. Of course, with all the state-backed loans, with all the financing the firm and the companies had to activate in the last month, the level of debt has raised, and we could expect, of course, with the rebound and maybe the bridge between now and the rebound, the companies will have to rethink their debt structures. And to talk about this, I'm glad to have Barry Kahir on Visio with us today. Hello, Barry.
Bonjour.
You are a vice president at Insol Europe, and of course you are a lawyer too. Jonathan Elbaz, partner at Solve.
Hello.
Thank you. You are one of the most visible receiver in France. And Vincent Catherine, managing director at Octree Capital.
Hello.
Maybe as an introduction, we have the chance to have you, Barry, here with us. Could you please share with us some thoughts and visions and maybe trends from Insol on the pan-European scale, maybe in Ireland too, since you are in Ireland right now?
Sure, thank you very much. Et merci beaucoup de m'avoir invité. Je suis désolé que mon français ne soit pas meilleur. Alors, je vais continuer en anglais. So, yes, Insol Europe, for those of you who don't know about it, is in fact an association governed by French law, in 1901 law, I believe. And it is celebrating 40 years in existence this year, so it's a testament to the value that members find in the organization. It has over 1,200 members, made up of lawyers, accountants, and insolvency practitioners, lenders, regulators, judges, academics. So a very broad range of members, and we have a lot of working groups aimed at people's specific interests, whether that's lenders groups, a judicial working group, and so on. It's also in itself a member of Insol International, which is the global insolvency and turnaround association with over 10,000 members. So the network is truly global. And members of Insol Europe come from over 50 countries. So it's not just Western Europe, and it's really Europe in the widest sense of the word. The trend at the moment, insofar as we can detect any trends, is that insolvencies and formal insolvencies are at their lowest level for very many years. The number of filings is down in almost every jurisdiction that we hear from. We had at the start of this pandemic, when you shut down an economy for any period of time, we had expected a tsunami of restructuring cases, but the opposite has been the case. Whether that's due to the government supports in place, which disguises distress, we don't know. That will be revealed in time, I think. Having said that, some sectors of the economy have held up very well. I've seen in the M&A activity in Ireland, at least, and in the private equity segment in particular, that activity has been strong and values have held up very strongly in certain sectors. On the more sort of pan-European and EU horizon, we're looking at some new and further harmonisation of insolvency laws. We might talk about that in a little bit more detail later on. It may well have an impact on certainly where restructurings will take place, but also it might have an impact on debt structures and the ability of lenders to act if there is a moratorium in place. The trend in Ireland replicates the trend elsewhere. We've had record low numbers of formal insolvency cases. We have had a lot of the throughput has been related to global retail, so we have had cases There has been a retail focus, but it has been international brands restructuring and the Irish businesses forming part of that global restructuring. The more newsworthy trend has been in the aviation sector. Again, despite the almost complete shutdown, the sector has withstood events so far, and we have not had as many formal filings as we might have expected. However, we've had two sort of pan-European operators filing for restructuring in Ireland, the CityJet Group, which is an Irish company but flying mostly on wet lease in Scandinavian countries, and more recently Norwegian Air filed for bankruptcy in Ireland, availing of our examinership, which is close to Chapter 11. So again, it was a bit of a surprise to a lot of people, I think, that Norwegian Air would file in Ireland, but in fact, the aircraft it's utilised were held through an Irish company. So when you look at it a little bit more closely, it wasn't as surprising. But whether that's a trend arising from Brexit or some other issue remains to be seen, but it's a discernible trend at the moment.
Thank you, Barry, for this introduction. So even if the insolvencies level are really low for the next year, for the last year, we have an unparalleled debt tsunami or debt wall to tackle for the next month and years. Jonathan, many LBOs have requested these state-backed loans from the banks for different reasons, because of the sectors or because of other operational or strategical reasons. We will have to reshape these debts. How do you restructure a state-backed loan in an LBO context? It's quite a tough subject.
Yeah, I think it's a good question, because we know that almost every company had to use PGE loan, so PGE, prêt garanti par l'État, to get emergency liquidity, emergency cash because of a health crisis. To give you some figures, we are talking about 130 billions of debt which have been distributed in France to around 650,000 companies. So PG debt will necessarily constitute one of the main components of almost every restructuring, and for LBO too. So the question that we have as practitioner is how, this is your question, how can we restructure this kind of debt? It's important to recall that it's very recent, so we are dealing with the first restructuring today of PG loan, and so the legal aspects of this kind of restructuring are evolving, not every day, but we are in the process of adapting to this situation, which evolves very quickly. So our question are the legal constraints, because one of the main things when you contemplate to restructure a PG loan is the question of the guarantee of the state. The main risk for banks, for lenders, is to lose their guarantee in the frame of such restructuring. Therefore, we try to understand what can we do when we need to reshape, to renegotiate a PG loan. We have, I think, two big questions. First question is how can we modify the amortization plan of a PG loan. Let's assume that you have a loan which has been agreed with a lender and with an amortization plan. Can we reschedule it without taking a risk for the bank to lose its guarantee? It's something which is not stable at this stage. That's what we see. But it seems that it's possible in certain situations to renegotiate the amortization of a loan without losing the guarantee for the bank, but with one hard stop, which is the 6-year period of this kind of loan. So till you stay in this period of 6 years, it seems that you can reschedule this kind of loan. That's the first thing. The second thing, and the second question, is that when you are facing a situation where you are looking for some liquidity, and that you have, for example, a third-party investor which requests some write-down from lenders and for a PGE loan, the question is that could the bank accept this kind of write-down in an amicable restructuring without losing its guarantee. And again, we are working on the first situation, so and can evolve, but it seems that it's possible to contemplate this kind of negotiation with banks and with PGE loan and restructure this kind of loan with, for example, a partial write-down and a waterfall, but till in the 6 year period. So one of the main constraints is the 6-year period, but it seems that it would be possible when we will face this kind of situation to find solution and to restructure this kind of loan.
So the idea is the game rules are 6 years, between now and in 6 years, and in this period you have some agility and you can trigger some levers and you have some place for creativity in terms of legal and financial tools or new ways of doing things.
It seems so, and so it means that even if you are negotiating, for example, a waterfall of on the partial debt which is written down, the waterfall can play of this kind of debt, but within a 6-year period.
Okay, thank you, Jonathan, for this point. On the investor side, Vincent at Octree, you work, what you do is to deploy equity, but also special situation debt. We know, of course, Octree on these both aspects. You do that in many companies. Is it easy to find targets nowadays? Because after all, after 2-3 years of complex activities for example, the retail sector with some gilets jaunes or some other things that are far behind now. But is it easy to find people able to open their equity widely, or is it easier to find people with needs in terms of debt? How do you see the market?
It's a great question, because right now it's fair to say that it's a pretty difficult market to be investing in. I mean, there's never an easy period because of the oversupply of liquidity that we have, but it's a pretty peculiar atmosphere, very different from the previous cycle of restructuring. We have a pretty unique situation in which the liquidity underlying in the market is absolutely massive. And we should reiterate that the capital markets are functioning extremely well, which is a big difference, i.e. most of the large-scale borrower can access the convertible market, the bond market, the private placement. Every, I would say, aspect of the capital market is functioning as a well-oiled machine with capital. The cost of debt is as low as it's never been. Obviously, we discussed the state-backed loan have provided ample liquidity to a lot of companies. I would say that obviously there's a disconnect between some of the smaller companies that have struggled to get that type of financing, but I would say it's been mostly functioning quite well across Europe, in particular in France. The loan docs also that have been obviously in the LBO world are super flexible. There are a lot of Cov-Light, etc. So it's a weird atmosphere, because it's like everyone is looking at each other saying, you know, do you need equity? Not yet. When? We all know it's going to happen, because fundamentally we pushed for some of these companies that debt wall that you were mentioning by a few years. And so you end up into a situation whereby if you're an investor right now, you're caught in between, I would say, companies that have been shielded from the pandemic, or on the opposite, have accelerated their development because of the COVID crisis. So it would be software company, healthcare. These sectors are massively invested right now. So you can see, everyone can have his own opinion, but obviously the valuation multiples have never been that high in these sectors, but for good reason, because they're good underlying companies and obviously growing very fast, but it's super punchy valuation to be in. And on the opposite, you got sectors that are currently quite tough to invest in, retail, office development, you name it, whereby whatever your conviction or your gut or your willingness to invest, it's just tough to invest right now. So you need first of all to have a pretty wide toolkit of pockets of capital that you can deploy, i.e. junior debt, pref equity, because it's very difficult obviously to value a business right now. So the pure equity component is difficult because you got EBITDAs that are totally deflated by the current environment. You got long-term question on the recovery, how much time. So very difficult to price businesses. So then obviously having that kind of structured solutions with pref equity is generally at least a nice addition in your dialogue with the borrowers and the companies. And fundamentally, you need, as an investor, to take a couple of conviction bets about the upturn, when it will reopen, and taking long-term views on sector where you feel pretty good that there will be a back to consumption type of environment. But whether it's 6 months, 1 year, 1 year and a half, no one knows. But you probably need to take this decision right now and make sure that you got enough liquidity in the companies you invest in to avoid the horrendous scenario in which in 6 to 9 months' time, you're back at the table to provide further liquidity, which is obviously the risk we would like to try to avoid, and to once and for all, we are quite, I would say we are trying at least to make sure that if we invest in a company right now, there's a once and for all investment, maybe size in a different tranches, maybe, but because we know that unfortunately there will be many people coming back at the table and coming back to your table to restructure a pretty complicated structure. Having said that, and I think that was very encouraging to hear what you said about the innovation and the first loan. In this time of crisis and acceleration, the innovation, the legal innovation accelerates also in parallel. So we saw that in the previous cycle, Sauvegarde Financière accelerated. There were plenty of innovation on that front that allowed the companies, the borrower, the investment markets to get access to new tools and to allow for this type of restructuring, because effectively on the PGE side, we know that a portion of it, without crystal ball, we need somehow to find a new place within a complicated capital structure, because they for some of these companies maybe considered a bit as equity. But there's a big debate ongoing, but the answer will come over the course of the next few years.
Exactly. And Vincent, you talk about the potential quick rebound, and right now you told me also that the companies that are talking with lenders right now are meeting an increasing adaptability of the lenders. You spoke about innovation, but also in the documentation.
Yeah.
How so?
But documentation is clearly adapting to the COVID environment. So you can, for instance, you got some companies that are, and some of the legal teams that are advising these companies are building in features that linked the maturity of your loan to the reopening, the end of the administrative shutdown on some sector in the F&B, in the hospitality space, so that you linked the maturity of your loan. You link some of the covenants. You have de facto covenant holidays for some periods, depending on the administrative shutdown. You start that new world that is emerging is being obviously featured within the documentation to be able to warn in advance and having a mechanical ability to deal with a new shutdown in 9 months' time, 12 months' time, 24 months' time.
And are these innovations are all creditors are able to do such tailor-made, or is that something you will only find in private debt funds or private placement with a documentation you can, with people more sophisticated maybe? The same question maybe for Jonathan, if you already seen with the companies you are with, if you've already seen some details like that in the documentation.
No, on my side, no. I think it's very interesting. It works a little bit with that, with a deferred payment, for example, for the PG loan, because the idea is to link the period of reimbursement with the fact that the company could again work. But I think it's not on the bank side. It's more private debt, I think.
Yes, yes. We see that for the timing in private debt, but obviously the banks are catching up with innovation, and I'm sure they will be able to provide that type of also financing solutions. Huh? Innovation is a spread.
The problem for some of the banks. The problem for some of the banks, certainly in this jurisdiction, is that they are restricted and they don't have the flexibility that the private equity has. And we've seen some deals where the mezzanine has flipped into equity, and the banks and credit lenders stay in place. And the banks can't look at solutions where they might be taking assets out of liquidation.
Yeah. And what if these first corrections you can negotiate with your creditors and lenders? What if this is not enough? What if we need to even go further in the tools or in innovation or in new market practice ways of doing restructuring and in insolvency? Do you already identify some clues about where we could go on the European side, maybe in a cultural change in the lender point of view?
I think on my side, so we handle very distressed situations. So we are not in front of a normal situation. We are in front of situation where a company is running out of cash. The loan which have been injected are not enough. And so the question for us in this kind of situation is more how could we find new liquidity? And the question is more about getting some new equity. What we see currently in many cases is that for distressed company where you're looking for new equity today, the conditions are very, very demanding for all the stakeholders. The third-party investors, because of a lack of visibility, because they don't know where the crisis will end, when the company will begin to work again. For some company which are totally shut down or find again, be break-even again, the requests are very high. And so the question for the stakeholder is, I think, is the shareholder able to inject again more new money in the business? And regarding the amount of debt, even when it is in capacity to do so, he will ask the question of also reshaping the debt. So what we see is that looking for investors today for this kind of situation, we face investors which are more looking at buying the asset in kind of pre-pack or requesting very, very high write-downs for everyone. So I think that what we see, the question is also to maybe find a solution where a shareholder could invest, but discuss with its lender about reshaping the structure.
As a matter of fact, it appears that it's sometimes better for everybody already in the firm to postpone the decision and to preserve their own interest. But Vincent, third-party capital and turnaround funds, they are more than representing a good alternative in the case of not only emergency, but also of rebound, of revolution of the firm, transforming and realigning interest of everybody for a new adventure.
Yeah, and clearly that's part of the topics that are of big relevance for us right now, is to provide a relatively holistic capital solution that allows you to play defense i.e. to restructure your capital base, give a bit of liquidity on the existing portfolio, on the existing assets. Simplify generally also the number of lines in the capital structure, and at the same time provides further capital for development, because for a lot of sectors, the opportunities will come over the course of the next 12, 36 months of consolidation, acquiring competitors that will be in distress. So there is for some of the, I would say, most agile operators in some sector, there is a hunt for that type of capital to secure it now and to get your war buffer ready for action when in 6, 12, 24 months these opportunities will come in. And so the arbitrage for the borrower is to say, if I go with a private debt custom tailored solution, I will probably embark a higher cost of capital than what I used to have or what I think I can have with few lines of liquidity, taking an additional help. But fundamentally, there's again this question of doing it, quote unquote, once and for all for the next few years and be ready for action. But you're right, with generally some demands, whatever the fund may be, there will be some in that kind of high risk environment. It's a risk return game, so the return is also, the return expectations are obviously increasing for that type of solution, and obviously trying to get as much possible legal protection on your investments, which is why we see more and more fiducie type of structure in France being implemented as a protection for the lenders.
And we will talk about that, but just a question: has state, for example, in France or in the countries where state-backed loans are very common, has the state become the toughest competitor for you? Because all the companies that have enough cash just to survive for the next months without doing what they need to do in terms of investment, do they really want to do something? And if they don't, how do you manage this negotiation? What's the trigger for them? I know it's a tough question because every situation is different, but
I'm tempted to say time will tell, but no, I don't think you should view that as a competition. It's just it's been an extremely helpful, quick answer from the governments to stabilize the situation and avoid, the European economy going to mayhem and havoc. And so we should all be thankful to the reaction of the government as a whole. Now, effectively, we know that it cannot be a permanent solution, and there will not be a wave 2 or maybe a wave 2, but there will be no wave 3. At one point, that wave of public money will stop and needs to obviously transition towards private capital. And this moment of transition, some companies will effectively feel the difference from obviously the requirement standpoint. But obviously, there will be the need for some negotiations with the French state in some of these loans, that's for sure. And
maybe a bonus question, but as we speak, we see that on the bank side it's getting more and more intense and difficult for them to see and to prepare themselves for the big times that are going to happen. On your side, is it a good window right now to engage restructuring of the debts, or is this still a period, or can we still expect the rates and the level and the cost of debt to stay as low as we have seen since the last years and still today?
You mean from a capital market perspective, should you lock in that type of financing rates now?
For example.
If you have access, yes, it's a question of effectively we're talking about the top companies that have no problem and that are getting super cheap type of financing on every product. Then you have, unfortunately, the company in pure financial distress, a lot of difficulty to have access to financing in any form whatsoever. And you got this obviously in between, which are most of the companies that are suffering, struggling, but know that they will be back. And the question is when, and are trading, 30, 40% off their EBITDA pre-crisis. Do you wait a bit to tap additional financing? Do you dilute yourself by taking equity right now? It's the debate all the borrowers and the companies have right now is, should I take this relatively a bit more expensive? Should I dilute my equity right now? Should I wait a bit more because the rebound will be drastic? It's also a question of sizing the liquidity needs of the reopening. So on some of these companies, it's like you will have big working capital swings that need to be financed because it's like a bathtub. Once you say, okay, let's reopen, before plunging in the bath, you need to pour a lot of liquidity. And I'm not sure all the companies right now have this access to liquidity. And hence, obviously, the need to probably secure that pockets of liquidity now to be able to follow the rebound and finance the rebound.
Especially for the companies that will have to consider the need of liquidity in business model evolution, which is even tougher than just reopening a hotel or restaurant where you know basically how it's going to work. Jonathan, on the small, medium companies, even if you also advise, of course, large companies, but on the small, do you have the same lecture as Vincent in terms of financing? Is it right now the moment to secure financing, or maybe there will be even better situation to finance these companies?
No, I think it's clear that if you can have access to the liquidity, you have to use it and to take it. For some companies which are, for example, closed, they don't know when the end of the crisis, when they could operate again. Maybe they have a feeling that it will be better to try to obtain some liquidity when they will have more visibility to convince, of course, the lender of the capacity of reimbursement. So it depends also on your activity and of course, your capacity to have access already to such liquidity.
It's a very good point, because drafting a business plan right now, art rather than science. Huh?
After the last 2 years and in 2021, it's not easy. Jonathan and Barry, the European regulation, we quickly talked about it at the beginning of this conference. There is a new regulation, of course, the European one that will be implemented in France in June, in late June, beginning of July. This will necessarily have impacts on negotiation, especially on non-jurisdictional procedures. What is your vision about these impacts? What will it change, and how will it be interesting for lenders or shareholders, third-party investors?
Me or Barry?
Yes, and Barry then.
I think that for practitioners that work in the frame of preventive cases, mandat ad hoc, conciliation, we are very careful about the question of how this directive will be implemented under French law, because what is clear is that today, when you negotiate in the frame of such preventive process, the alternative is the failure of this process and necessarily the opening of a bankruptcy process. Therefore, if you change the way it works, you change the alternative and you change maybe the power balance in the frame of this negotiation. And today, it's clear that the debtor, I would say also the shareholder, have maybe some power in this kind of negotiation, because the alternative of a bankruptcy process is generally very bad for everyone, but particularly for lenders. Of course, the fact that with the transposition of the European directive, maybe lenders, secured creditors may be able to impose a plan or maybe take control by conversion of debt, is something that we follow with, we're very cautious on that, because I think it's important also that even if it creates a major change in the power balance, it should not push some manager to delay reporting difficulties or some companies to report difficulties, because they will be scared of losing control of their company. So I think we will see in the next weeks how the transposition will what will be chosen.
Barry, on this European regulation that we are all expecting?
Yes, well, it's interesting. We do all talk about June, July for implementation.
We don't. Sorry, Barry. We don't hear you very well. Sorry.
Okay. Better.
Better. Thank you.
We talk about June, July for implementation, but it is likely that many jurisdictions will avail of an extra year before implementation. The other issue would be that while it's aimed at further optimization.
I'm sorry, Barry. I think your mic is not working anymore, or not very well. Do you?
Okay. I can remove the headset.
Yeah, I think maybe it will be better. Sorry.
Can you hear me now?
Better. Thank you.
Much better.
Okay. I'm sorry, I'm going to start again. I was just saying that we talk about June or July for implementation, but many jurisdictions will avail of a 12-month delay before implementation. I think the problem also is that while the directive is aimed at introducing similar procedures across the EU, because it is a directive and it has to be transposed, there is a lot of discretion for jurisdictions to include elements, exclude elements. So while a reduction in arbitrage between jurisdictions is desirable, it may not be achieved by this directive. But broadly speaking, the discussion around the power and the balance is the big difference, because it's actually going to be a debtor in possession process with a stay and cross-class cram-down, which will be new for a lot of places. And it's also potentially a ban if there are factual clauses. So it is going to be a new rebalancing. The main objective, however, and it's frequently described as a pre-insolvency restructuring tool, and therefore it's hoped that if there is an imperative on the business to make the filing early, that the options won't be binary between success of the plan or liquidation. Because professionals, we always say to companies in distress that the earlier they get to us, the more options they have. And it is designed as an early warning system and an early intervention. And hopefully that will mean that there will be more options available.
Thank you, Barry. Vincent, Jonathan, you told me during our preparation that you also have experienced an increasing level of acceptance on the borrower's perspective. We've talked about fiducie also. Mm-hmm. How so, and could you explain us about this point?
You want to? No, it's true that some of the features of the private debt markets that were probably a bit difficult to accept for some of the borrowers, including, I was mentioning, the fiducie when you have identified stable, well-identified assets. Obviously, in a more difficult environment, there is some leniency and some level of acceptance that has increased on some of the borrowers in order to give a better protection to the lender in obviously if you need to go back to the table into a very uncertain and volatile environment. Because of the, let's say that the restructuring scenario, the occurrence of a potential restructuring scenario is more in the minds of everyone. So everyone is now projecting itself and saying, okay, I get it. If there is something wrong, there are maybe a pocket of value that I'm unfortunately willing to go away. When the weather is sunny, it's more difficult to force people to think about that restructuring option. So I think everyone, both borrowers, companies, the advisors, and obviously the administrator, we're all working together to try solutions, obviously that are okay for everyone to accept.
No, I would just, I'm totally in line. I would say that because this is also an unprecedented crisis, we need all to be very pragmatic to find solutions for us to save companies, to save jobs. And so you need to be innovative, you need to find solutions and maybe adjust some long-standing principle or some barriers that we couldn't met in the maybe before the crisis. So what we see, of course, is also what you say is maybe borrowers who are more open to innovative solutions.
The question is, do you have assets you can put in the fiducie? If you don't, what do you do? Actually, I have already an answer, or actually a second question that could give us the answer. We have several questions on the chat. Talking about something actually we've not talked about today. It's working capital, and especially there is a question about what are your views about factoring as solution to finance the rebound? Could it be enough, especially when you don't have any asset to put in the fiducie? I don't.
The answer is in your question. we effectively hope, and yes, I mean it's true that the factoring market has also evolved in terms of innovation, capacity to increase the LTV, the LTV, capacity to value some stock historically that were pretty, let's say, not too mainstream, and so that innovation has also caught the factoring market, and obviously the more we can use that type of weapon for companies, the more everyone is pleased, because obviously if you can have a working cap backed facility, your cost of capital will be much lower, and you can reduce the size of the, let's say, the unitranche or the preferred equity, etc. And generally, I think, at least from an investor standpoint, we would very much favor taking as much possible factoring backed debt.
Okay, one last question maybe. What are your views about all the LBOs that are actually closed without debt? LBOs with no leverage because the companies are already facing a lot of debt. We've seen in 2020 some debtless LBOs. What are your views about that? And is it something that can be applied to small, mid, and large caps?
Well, it's generally because the debt is already built in the company, or you're predicting probably a deterioration of the cash flow over the next 6 to 24 months. So I think investors are thinking about your pro forma capital structure effectively that the wall of working cap financing will be passed. So when you say debtless, it's debtless on a spot perspective, but you're de facto embarking in your conviction, in your business plan, you're probably embarking a reasonable level of leverage. And the other thing is true that the financing market and the banks and the private debt markets, and I would say all capital markets, have highlighted a couple of sectors that are totally unable to be financed by debt right now. Well, it's not going to last forever, and what you can probably do is to say, I'm doing an all-equity deal on the back of taking a bet that in 12 months' time or 24 months' time, this sector will reopen for traditional senior debt to come back, and de facto I'm pricing that over-equitization for a limited amount of time. And you de facto reflect it probably in your valuation.
Well, thank you very much. I think I had all the questions for the speakers. This is the end of this panel. Thank you very much, Vincent. Thank you very much, Jonathan. Thank you, Barry.
you, Mathieu.
Thank you.
I wish you a wonderful day for the last panels you can enjoy right now in 10 minutes in the turnaround room or in the other tracks. Thank you for the speakers. Thank you for the sponsors. Have a nice day and see you in a few minutes.
Thank you very much.
Thank you.
Bye.